Hi everybody, this is Ted Bauman here, editor of the Bauman letter. I've been off video for a couple of weeks, had some wisdom tooth taken out and I didn't look too good, but here I am back again. Today I want to talk about the issue of volatility. Now, in market circles people often speak of October in hushed tones because it's considered to be the month of peak volatility in the stock market. Now, the question is why that would be the case and what that means for you. Well, first of all, October tends to be a month where trading volumes are somewhat lower than normal. There tends to be a bit of a pause in the market's activity as various players look to reorganize their portfolios towards the end of the calendar year. But it's also a month in which some institutional investors like to do some large volume trading for specific reasons, like to rebalance their portfolios. I mean, for example, just let's say for argument's sake that you have a portfolio that's you want to be 60% equities and 40% bonds. Well, if equities have been going really strong but bonds haven't, you could end up by October having 80% equities and only 20% bonds. So October tends to be a month when some institutional players go ahead and make the trades necessary to bring them back to a 60-40 proportion. So that's one factor. The other factor is that a lot of large trading institutions like hedge funds, mutual funds, and so on also tend to start looking at making trades in order to harvest tax losses before the end of the tax year. Overall, what you find in October is that there can be a lot of trading that is not really driven by the same kind of dynamics that you find during the rest of the year, which is basically people trying to make money from looking at good value in stocks, good growth, good momentum, etc. Now, one of the consequences of lower than normal volume overall, but this large volume of institutional trading, is that sometimes you can have pretty big swings in the prices of particular stocks and particular sectors as institutions, for example, reduce their exposure to something like technology. So, for example, some of the swings that you see in indexes like the NASDAQ are not necessarily because people are moving away from technology stocks, but because maybe they're actually selling some of that in order to be able to free up some capital to invest in other things. Now, as a result, October tends to have historically quite high volatility. But the key thing about it, though, is that this volatility does not translate into any kind of long-term market movement on its own. For example, historically, every time you see a spike in volatility in October, people tend to say, well, that means that something's going to happen. Either there's going to be a big crash or there's going to be a big breakout or something like that. But historically, the people who measure and keep track of these things have found that actually there's very little evidence that there are big market swings, like big changes of direction in the overall trend of the market following an October, even if it's a very volatile October, right? So that means that the volatility of October does not necessarily mean that there's going to be a fundamental change in the direction of the market, right? Now, that means that you have two competing tendencies really that tend to get in the way during October, and I think it's important to be aware of that as you are thinking about what you're going to do with your portfolio. One is that you're looking at this volatility and you're thinking, my God, I've got to do something quickly. I can't take a big drop like this. I need to either get out of a position or maybe I should jump in and buy at the dip. Well, sometimes that's exactly what you should do, but sometimes the best thing to do is just to hang in there and wait for October to end, because as I said, there isn't really evidence in the long term that volatility leads to a change in the direction of the market during October. In other words, October itself is not an indicator that a bear market is around the corner or a bull market is around the corner, or it's not really an indication of anything. All it is an historically volatile month for technical reasons that tends to have a lot of up and down in stock prices. So that means that October is the time to hang in there and do what I always recommend, which is try to distance yourself from the emotional part of trading and focus on the long term. Now, one of the benefits of the kinds of products or the kinds of services that I offer, the Alpha Stock Alert and the Smart Money service that is part of my Bauman letter, is that these are systems that are designed around algorithmic trading. In other words, they're based on signals that are drawn from market indicators. They're not based on just me or anybody else making educated guesses about where stocks are going to go. They're based on an accumulation of solid data points that backtested have basically beat the market by hundreds of percent over a number of years. So the key thing about these products, these kinds of systems like the Alpha Stock system or the Smart Money system, is that they allow you to back away from the kind of nervousness that you tend to find during a volatile month like October and let the rules do the work. And right now what I'm seeing in my systems is that the rules are telling us proceed as normal. It's not an unusual situation, so just relax, don't panic. Anyway, that's the system I'm going to keep following, and I recommend that you consider doing so too. This is Ted Bauman from the Bauman Letter signing off. Thank you very much.